Good afternoon, everyone. I appreciate your time today. I'm John Halley. Thank you for coming. And I'd like to introduce the portfolio manager at SEM, who's going to host our webinar today. His name is Jeff Hybeck. And Jeff, take it away.
All right, thanks, John, and thank everybody for joining us. I know we just did one for a larger audience a few months ago, and it's been on the blog. So we're going to talk a lot about similar things, but we're going to give an update, especially as we head into now what is going to be the last month of so far one of the worst years we've seen in the stock market for really the last 30 years. So one thing I talked about last time is how much I hate the way Wall Street talks about, defining things. And they've always said, simply a bear market is if it drops 20% from its high, but then they call it a bull market if it rises 20%. And you can just see, looking at this chart, the last two times we've seen the market drop 20%, the Google searches for bear market spiked. And so you could see June 12th of this year is when everybody said that we were in a bear market. And then prior to that, during COVID, March 8th of 2020 was the last time the market had dropped 20% from its peak. But I don't always use Investopedia, but sometimes they do have a lot of good information. And I think this is what's important for people to understand. And I've seen kind of a split of our client base and talking to other advisors across the country of where we're at right now. And we've had a huge rally. We had the best October for the Dow and one of the best Octobers for the S&P 500. And it's kind of got people to say, well, maybe the bear market is over. And what I warn about that is I don't believe the data says that the bear market is over. We're having a pause. We're having a nice rally. But the true bear market is a prolonged period of price declines. It's not just because it went down 20%. It's that prolonged period where we're losing money over and over and over again. What I think is important to understand is all bear markets are not the same. What's really been difficult this time around for most investors is this blue line here highlights the losses on the bond market. Now, this is the aggregate bond market drop. You could see that it's not, always gone down as much as the stock market until this time. And in fact, yesterday I was meeting with a professor of finance at Liberty University, and he wasn't able to get me the chart for this webinar, but he was talking about a scatter plot going all the way back to 1876, showing the returns of bonds and the returns of stocks. And he said this year, the point is all the way off in the far left corner, meaning we've never seen a period of time where stocks and bonds have lost this much money at the same time. Normally, you'd see bonds lose very little or even make money when the stock market is down. So we've never in our investment lifetimes seen the bond market lose this much money at the same time that the stock market has lost money. And looking at all bond portfolios, pretty much every bond investment I've looked at has never had a worse drop than they're having this year, with the exception of SEM's bond portfolios. And we're going to talk about those a little bit more, but I think that's important to understand is we modeled out what the risk should be based on both our 30-year track record as well as what the investment models have done when we go back and do our back testing. Now, obviously, we can't back test to 1876, but we have been able to go back to 1989. And our models said that we should expect around a 10% risk level from high to low in our investment, in our income portfolios. We have not gotten there yet. And I think that's phenomenal to think about. Think about this. Pretty much every bond investment is having its worst loss ever, except for SEMs. Now, we don't like losing money. However, we are still within the parameters of what we modeled out. And I think that's super important to understand, especially as we talk about what to expect as we head into next year. And the other thing I really want people to understand is this experience is much different than the 2020 drop. Remember, in 2020, we had a common enemy. COVID came in, our economy shut down, and then Congress and the Fed came to the rescue, and they tried to bail everything out. Now, as we go into 2023, the solutions to fight the last bear market are actually the problems that we're facing as we head into the next year. This is a different scatter plot, but to kind of look at the losses that we've seen and how long it took for them to recover. And it just kind of is a different way to look at how different bear markets are. But I want to reiterate this. I shared this during our last webinar, is we're looking at a recessionary bear market right now. And all of our data is pointing towards, we're heading towards a recession. We're not there yet. I know there was some argument over the summer about whether or not we're in a recession. And, I'd say the data says we're not there yet, even though a lot of people define recessions as two or more quarters of negative GDP. The reason they don't do it that way is because then the third quarter was positive, which would technically, if you use that other definition, mean the recession's over, when the economic data says we're still not quite there yet, but we are definitely heading towards a recession. Is the bear markets are going to be different. If we're heading towards a recession, the stock market typically loses 42%. At its worst, it was down 24. Going into today, it's down about 17-ish% from its high. So, and I don't want you to be scared about this, because I'll talk about how our portfolios have adjusted here in just a minute, but we still, if we are in a recessionary bear market, have maybe another 30% down if you look at a normal recessionary bear market for the stock market. I'm going to talk about bonds here in a little bit, but for the stock market, buy and hold basis, there could still be, if we go into a recession, another 30-ish% down if you look at the average recessionary bear market. Now, here's an updated look at our leading economic indicators. And one of the things that we've seen is the only thing really holding out is the jobs market. And we're going to get another report of how things looked in November here on Friday. But that's been the real shining light. And that's what's kept everybody from defining what we're in right now as a recession, because you've never had a recession where we've had increased number of jobs. And that's something important to understand, is as long as jobs are increasing, we're okay. But we're starting to see pains already from the Federal Reserve's policies that the labor market is indeed slowing down. You've seen the tech layoffs. Now, the tech industry benefited mightily from the shutdown. Obviously, people spent a lot of money on technology. They got their stimulus checks and spent even more money on technology. And the tech industry thrived. Well, now they're having to cut jobs. And even Amazon, who should be getting into their busy time, has announced layoffs. And so we're probably going to start to see the labor market rolling over. And as that does, that could be a really big problem for the market overall. The other thing I'd just like to do to remind people, I've been showing this slide for the last 2 years, just to put things in perspective of GDP, our economy. You can see the big drop during the pandemic and this impressive rise, but overall, the economy is not that great. It does not justify the returns we saw in 2021, and it's a weakening economy. And if you take it a step back and you consider going all the way back to 2016, we've only seen a little less than 2% annualized growth. That's not great, folks. 3% is the long-term average growth rate for our economy. And we never even got there except for one quarter during the boom times under President Trump. So even with the tax cuts, we barely got to 3% once. There's some signs that things are broken. And our solution to COVID, and I put this here on the chart, and this is to scale. Half of our economic output was dumped into the economy. And this is something that, and I didn't get a chart done, but as I talked to the professor at Liberty University yesterday, we were kind of talking about, here's something important to understand. So Quantitative easing is essentially money printing. Obviously, we don't print the money because it's all computerized now. But the Federal Reserve created $5 trillion. The US government borrowed $5 trillion to stimulate. They had to issue debt. The Wall Street banks bought that debt, which would normally be equal. So we wouldn't have seen inflation. The reason we saw inflation this time around was the Federal Reserve then created $5 trillion and gave that back to the Wall Street banks and took the debt onto the Federal Reserve's balance sheet. So we borrowed $5 trillion, but it had the impact of $10 trillion. That's why we saw inflation. People who didn't need money got money. If you were retired and on a pension or Social Security, your income wasn't cut. And you couldn't go out and spend money, yet the government sent you checks. If you were like John and I, able to continue working from our laptops, our income wasn't cut, yet the government sent us money. Those stimulus checks got spent because people had all this excess money, and it literally broke our economy. And now we're paying the price for that. And I believe that's what the situation going into 2023 is going to be, because the Federal Reserve is now trying to figure out how do we pull back that money that we put into the system without causing a recession. And I think it's almost impossible for them to do. Here's an updated chart of consumer spending. And I've pointed this out since 2021, that last diamond there, when that last stimulus check hit, we were already back to normal spending levels. We'd gotten back to the trend line, yet the government sent us checks. The Federal Reserve basically financed that and doubled the value of the checks as far as money circulating through the economy. And we got inflation. And that's what happened because people spent their money. I think the bigger problem, though, is when you adjust for inflation, and we're seeing this right now, and I think it's going to be an even bigger problem going into the next year, unless the Biden administration changes some of their policies, and I think, I don't know where the student loan forgiveness is going to end up, but the important part being missed there is people are going to have to, for the first time in almost 3 years, start paying their student loans back. And the average student loan payment is about $400 a month coming out of their budgets. At the same time, if you look at from numbers from a year ago, the average household is spending $450 more on food and energy per month than they did a year ago. So that's almost $1,000 if you have student loans coming out of your budget that wasn't there a year ago. And I think that's going to be a really hard thing for our economy to overcome. Looking at the stock market, one of the things that I always remind people of is buying the dips works until it doesn't. And we've seen buying the dip be a very successful strategy going all the way back to March 2009, because every time the market dropped, you were able to get in at lower prices and you ended up making money on those trades. This time around, though, the Federal Reserve is fighting us. They're literally, there's a adage on Wall Street, don't fight the Fed. Well, guess what? The Fed is saying we need to slow things down. So the dip buying stopped working. This is just another reminder chart. When the market goes up, 15% annually over a long period of time, that's a bubble. And we have to return back to normal. 8%, if you add dividends, you're 9.5% annualized returns for stocks. When we get above average, we have a period where those excesses are removed and we end up being below average. This chart updated, I think this is super important for everybody to understand. This is the market going back to basically the last 12 months. And the peak in the market started when the Fed warned about the need for higher rates to fight inflation. They're literally trying to slow the economy down. They've never been able to slow the economy down without pushing it all the way into a recession. However, we've seen periods of time over the last 12 months where we saw a big rally. And then we saw reality set in and the market gave it back. And then we saw, the market rally again. And then it sold off some more. We're right now in the middle. October was great. November wasn't too bad. We're seeing another rally that I think is based on nothing more than hope. And this is normal for a bear market. Remember, during the 2009 till the present period, every time we saw a little bit of a drop in the stock market, the Federal Reserve actually backed off from their tightening policies. And so that gave a boost to the market. Well, right now, they're not backing off. And that's important to understand, is the Fed is not backing off from their policies. But even during the last two bear markets, we saw some huge rallies. Those rallies were chances for you, if you were overexposed to stocks, to reduce your exposure. And I'm only talking to people who have money outside of SCM, because SCM, as we'll talk about here in a minute, has done some proactive things with our portfolios so that you can actually buy the dips when it makes sense. These rallies, if you have money in a 401k or 403b or TSP or just outside of our management in a brokerage account, these are chances for you to right size your portfolio to match where you should be, depending on what your financial plan says. And John can help you a lot more with that. There's a 2008, 2009, again, 1, 2, 3, 4, 5, 6, 7 rallies of 7% or more. We actually saw a huge rally in November, December for the stock market, 24% before everything went cratering back down, before the ultimate bottom was put in. And the whole time the Federal Reserve was actually cutting interest rates. They were doing quantitative easing. Well, now they're not. They're literally raising interest rates and doing quantitative tightening. So I don't know why everybody is so excited about the rally in the stock market. If the Federal Reserve were to stop raising interest rates today, we would probably still go in a recession. That's bad for stocks. I can't emphasize that enough. A recession is terrible for the stock market. If you're a buy and hold investor, it's bad for the stock market. Now, looking at our normal cycle of behavior, I do not want this webinar to be designed to scare you. I don't want you to feel like, hey, there's nothing that I can do to do this. Everybody's going to go through these emotions. I personally go through some of these emotions, but I rely on the fact that we have a data-driven process to help us get through that. We've not seen people panic yet. We're not to that point yet, but we will. I truly believe when the next phase of the bear market, sets in. Again, I've done this for 25 years. I've seen 2 bubbles burst so far, and we're not to the point where everybody is so despondent that we've reached the ultimate bottom in stocks. And that's when the best opportunities are going to come in. Now, I'm going to just review the 3 steps that we talked about in our last webinar, just because I think it's really important for everybody to have the right mindset as we go into the year-end planning. Your risk pulse. And I say right now, I should have said, how uncomfortable were you before the big rally in stocks? Because we shouldn't let the rally change the way we feel about the stock market. Just because it's up doesn't mean it's not risky. And, the thing I emphasize to people, if you added money to the stock market in 2021, you probably added it just because the market was going up and things looked great. These rallies we're seeing are probably a good opportunity to adjust your risk. We always encourage people, risk.scmwealth.com. That generates an automatic portfolio review by one of the SCM portfolio managers here. And then we will get with John and we will say, hey, either you should adjust your portfolio or maybe everything's good. It matches where it should be right now. This is, I think, the most important part. And this is what I always tell people when they ask me, hey, should I get out of the market? I say it depends on what your financial plan says. We cannot answer your questions without the framework of your financial plan. Next step, we have to understand the importance of minimizing losses. When I look at everybody's portfolios, we've kept, unless you're the riskiest investor out there, we've kept your losses less than 20%, which means we don't have to take a lot of risk to make it up on the upside. And I think that becomes really important to understand is we don't need to take a lot of risk. If you lose too much money, then you have to take on a bunch more risk on the other side. The other thing I have to remind everybody to keep in mind is your the way we experience losses hurts twice as much as the joy we get when we have gains. So losses are more memorable, losses are more painful naturally. That's just how our brains work. And so when you're in a losing period, you have to remember to try to keep things in balance and realize that the market does go ebb and flow in cycles. We just got through a very nice 2-year period for the stock market. We're going to give some of those gains back, but that's going to set us up for a much bigger rally on the other side of this. The other thing we remind people about, behavioral biases cause the average investor to never get the gains that are out there, especially on the bond side. And again, I'm going to talk about bonds specifically here at the end because it's been a terrible year, but I think there's a lot of opportunities ahead for SCM's bond portfolios in particular. But the average bond investor for 20 years has only averaged 0.4%. That's way below a buy and hold bond investor, what they should have gotten. So you got to be careful jumping in and out of bond investments based on what's happening there. The other thing I want to remind everybody of is Vanguard did a study a couple of years ago, and they looked at it. This is Vanguard, who's always said, hey, watch your fees, don't pay too much. But then they did this study and found that after fees, people who had an advisor on their Vanguard accounts actually added over 4% returns higher than somebody who didn't have an advisor. The biggest components of that are the behavioral coaching and then the spending strategy. That spending strategy is part of your financial plan. So you're talking after fees, 2.6% returns the Vanguard found are given to a client because they had an advisor on that account. So that's something we've been doing throughout the year. And it's something that I think is going to be very important to remember as we go into 2023 is we're here as a resource for you. John's there. He's a phone call or an email away. SEM's here. Just take risk.semwealth.com and we will personally take a look at your account and see where you're invested and see if there's any tweaks we should make. Number two, the other thing we've done, I've already talked about at the outset, how we define our risk parameters and we're well within those risk parameters, but review where you're at and what the impact of this next leg down of the bear market is going to be. How much income do you need out of that investment portfolio? Where are you taking it out of? You want to take your income out of the most conservative parts of your portfolio. And then we always run worst case scenarios to try to look at things and say, hey, maybe we can do something different. The other and final step, develop a plan for any portfolio adjustments. And this is where, again, if you take our risk questionnaire, we can find your true risk tolerance. Are your expectations properly established? Are there components, that help you stick to your plan? We'll talk about that in just a minute here. Do you have to be right? I see so many people either jumping out of the markets, and that was actually one of the first questions we had come up with the registrations. You have to be right to get out, and then you have to be right to get back in. SCM's portfolios are designed to adjust differently according to that. And then most importantly, when and how will I make adjustments to my portfolio? You got to have a preset plan. So with that, let's talk specifically about where we're at right now. Now, I call this our bubble chart. This is the chart that we use to kind of display all of the different investment options that we have to build a customized portfolio for our clients. And you have risk across the bottom. So the further out to the right you go, the more risk that you have to take. And that should generate higher returns. So you can look at whether it's our core stock or our AmeriGuard and Cornerstone Max. Those are always invested in the market. They have a risk level of about 50%. Keep in mind, at its worst, the stock market was down 24%. So half of what should be expected in the bear market. I also, as I said, if it's a recessionary bear market, we would expect those to lose more money. Now, we love what's called a bucket system, and this divides your money into different buckets based on the objectives and the time horizon. So your buy and hold, always invested stock bucket needs to be very long-term. And I say 25 plus years based on risk. Given that we're halfway through a bear market, maybe it's 15 to 20-year buckets, but that's your riskiest money. Right next door to that, though, our dynamic aggressive growth and our Cornerstone and AmeriGuard growth are sitting at their minimum stock allocations. Now, this is different than our last webinar because at the end of October, the money we took off the table in February and March, and that's important to remember. Yes, we took our bruises in January and the first part of February. Going into the year, the trend was up. Growth was in favor. But when things started getting bad, we took money off the table. First in February, we reduced our growth allocations from 100 to 85. And then March 7th, we went from 85 down to 70. That means we had cash on the sidelines waiting to buy the dip. Well, the end of October, the trend indicator said, look, over the next 6 to maybe 18 weeks, who knows how long the signal will last, things look okay. So it put some money back in at much lower prices. So we're at 85% allocation on the growth for AmeriGuard, Cornerstone, and Dynamic Aggressive. But that can also go back to 70 if things start to reverse again and that trend indicator does that. But that's your bucket 5. Bucket 4, again, we're halfway through the bear market, so maybe we're talking 7 to 12-year buckets. And we're at about 50 to 70%. Now, this was 30 to 50% until October 31st, when we got that trend signal to take a little bit more risk, because we're looking at a possible continuation of the rally into the end of the year. Now, let's shift over to buckets 1, 2, and 3, which is our income models: income allocator, tactical bond, cornerstone bond, dynamic income, and cornerstone income. They've nibbled a little bit here and there into high yield bonds. And it seems like every time we get a new buy signal, we kind of get whacked on the head, and then we go back into a money market position. And we are taking a little bit of lumps along the way, but that's normal. That's how the system is designed. What's important to understand is when we buy the dip, if it ends up being wrong, we go back to cash. And to go back to what I said at the outset, we modeled 10% risk for these portfolios. Actually, dynamic income, we modeled 12% risk. We are very much in the expected risk range. And here's the beautiful thing. Going into today, dynamic income was actually only down 2%. We always combine dynamic income with our other portfolios. We have our multi-manager portfolio in there as well. Everybody is in their risk definitions and that bucket that we expected it to be in. But the reason the bond market has been hit so bad is everybody was worried about inflation, that the Fed did not have much control over inflation. I truly believe, based on the data, based on my experience, is we're in a situation where we're going to have declining growth and we're still going to have above average inflation. And what that means is stocks are going to continue to struggle. But AmeriGuard and Cornerstone, as I mentioned, their trend indicators reduced our allocation. If things start to roll over again, that 15% allocation is going to be taken off the table and go back to money market. Dynamic income. Treasury bonds are still struggling a little bit. Dynamic income actually makes money on a small amount of money as treasury bonds go down in value or interest rates go up. And that's an important buffer to everything else that's happening. And if we're in this period for the first part of the year, tactical bond is going to spend a lot of time in cash. Yes, it's going to try to get some high yield bonds in there. Our multi-manager portfolio is also going to try to get some high yield bonds in there. But we're going to spend a lot of time just sitting in cash waiting for this storm to be over. And I know a lot of you are from North Carolina. You've dealt with hurricanes and tropical storms the last few years. And we're just basically boarding everything up. We're writing it out. There's no need to panic right now because we've weathered the worst of the storm and we just have the last little bit coming through. And then we're going to have a chance to just rebuild from a much more stable place for our portfolios. This is an updated chart that I've been showing throughout the year. Most importantly, you could see AmeriGuard and Cornerstone sold all the way back here, back in February and March. Well, we're buying back in at a lower level at around 3850 on the S&P when our last sell signal came around 4200. So you can only buy the dips if you have cash sitting on the sidelines, and we have cash sitting on the sidelines. And I think that's important to understand. Finally, our behavioral approach, this pyramid that we've designed, has to start with the financial plan. Every decision needs to be made based on the financial plan. And from there, we will work on other things. So start with John. If you have any questions, start with John. Review your financial plan, see where you're at. We've talked a lot about it. We do ongoing updates for those interested, semwealth.com, that market insights there about halfway down the page. We have our social media links. I've been lacking just time-wise to get more videos out there, but we do some short form videos just to educate people on what's happening with the market. So we're at the 30-minute mark. I've already had a few questions submitted ahead of time. While I answer those, you should have in your toolbar a Q&A button that will allow you to ask a question, and we'll be able to get to those. So interest of time, the formal presentation's over. We have a couple prepared questions that I'm going to get to, and we'll stay as long as people are still asking questions. So the first question that came in was, why would I not just go into a money market account until the worst is over? And to that, I answer, first off, depends on what your financial plan says. If you're taking a large withdrawal out of your account and can't handle any volatility, certainly a money market or a CD might make sense. But the thing I always remind people about is when things feel the worst, historically, that's the best buying opportunity. Without data to drive that decision, it's going to be very difficult to decide when to get back in. And specifically for those lower risk buckets, income allocator, tactical bond, dynamic income, and our multi-manager portfolio that we manage, we're again within our risk parameters. And I believe based on the data and history in our models, we've dealt with the worst. The worst of the losses came at the beginning of the year when we were fully invested, before things rolled over. Yes, we might take a few more losses along the way, but basically the defenses are up. And if you sit in a money market account, you're going to miss the chance for those things to really save you from that. So I just want to be very careful with that. So, but again, start with your financial plan. The next question, and again, there's a Q&A button that you can click on there. The next prepared question that came in with the registration is, what does 2023 look like if we are heading to a recession? And I think this is a really interesting thing because the data is going to be kind of noisy. There's something in the economic data, and again, economists do their best to model it. I don't think there's any government conspiracies to make things look better. It's just our economy is $20 trillion. We have, 110 million adults, I believe, was the last number. And that's a lot of moving pieces. Hundreds of thousands of small businesses out there that aren't publicly traded. So nobody knows what's really happening until after the fact. But anyways, we have some seasonal adjustment factors. Remember, COVID started hitting in the first and second quarters of 2020. So that's going to skew the data a little bit. But what it's looking like is sometime in April to June 2023, they're probably going to declare the beginning of a recession. And where earnings estimates are right now for stocks, they're expecting 14 to 15% earnings growth for the S&P 500 in 2023. As those adjustments come down, because I've never seen earnings grow during a recession, as those adjustments come down, you probably see a big whoosh down for the stock market. But the stock market almost always bottoms before the recession is over. And in fact, there's been many times where they don't declare a recession until the recession's actually almost over. So don't wait for the official declaration of a recession before we actually get into a recession. And we actually did just post a few tips for recessions on our social media, and we'll probably reshare those as we go through December. But make sure your budget is taken care of, make sure you're ready cash flow wise for the recession. If you're still working, make sure if your job isn't as secure that you have an emergency fund and things set up ready for that recession. But I think it could be, kind of the tale of two, markets next year, where the first half of it is marked by the beginning of the recession, but I don't think it's going to be that bad of a recession as far as, the impact on jobs. We're not going to see unemployment spike to 10% like we've seen over the last couple of recessions. So it should be a little bit mild. So that was it that came with registrations. Dan did ask us, in the past, when stocks go down, precious metals, especially gold, go up. That didn't happen this time. Why do you think that happened? And I think, Dan, that has blown me away. And I've talked a lot about this with how difficult this year has been, because if you were right and said, I believe we're going to have sky high inflation, what does the textbook say I should do with my investment portfolios? And number one is you would have bought TIPS, Treasury Inflation Protected Securities. TIPS are down like 12% for the year last I looked. The problem was the market expectations were for higher inflation than we actually got. So the market got ahead of you. Even if you were right about inflation, they've actually lost money on TIPS. So that's been a strike. But gold, gold just has baffled me. I believe what happened is people saw all the stimulus coming in and they got ahead of that trade. And so we did see a big rally in gold in 2021 before inflation kicked in. And then when the Federal Reserve finally got around to saying, hey, we're going to fight inflation, people said, if you've ever heard buy the rumors, sell the news. Once the Fed said, okay, we're going to start raising interest rates, people started selling gold. And I've always told people that, the reason we don't do subjective investing where, hey, I think inflation is going to be high, therefore I'm going to buy gold and TIPS, is the reason things go up is more people buy than sell, and the reason they go down is more people sell than buy. So Dan, I know it's not, the best answer that everybody wants to hear, but everybody anticipated inflation as far as the smart money, the Wall Street traders, so they bought gold. And when inflation's actually started to hit, they said, okay, that story is over. I'm going to sell my gold. And that's what's happened. So it's been baffling this year. The only thing that's made money are dividend paying energy stocks. And, we have a little bit of energy in our portfolios. Cornerstone, I was looking, has a fund, Ave Maria Value Fund. This is not a recommendation for that fund particular, but it's up 6 or 7% year to date. We've been in it all year. They have a lot of energy companies inside of that fund. But that's the only asset class that's done well. And, I don't even know how long that trade's going to last. It's been a baffling year. And again, to what I said at the offset, what the professor shared with me yesterday is we've never seen, going back to 1876, this type of negativity from both the bond and the stock market at the same time. So the textbooks are not always right because Wall Street tends to get ahead of you. So that's a long way of me saying everybody anticipated inflation and they bought it ahead of time and then they sold it once we had it. So that's all we have for questions. I'm going to go ahead and see if John has anything else to add. This is being recorded. John will get you guys the replay if you want to go back and listen.
Jeff, if it's okay with you, I've had a couple of questions asked of me along the way, and I was just going to forward them to you. So would you spend just a minute or two talking about how the models and how our portfolios choose what types of investments to go into? This is kind of a feeding on what Dan was saying about precious metals, for example, and other types of asset classes.
Sure. In general, and specifically for precious metals, for those of you that don't know, Rick, my partner and founder of SEM, is originally a metallurgical engineer. Our head of research, Steve Goat, has a PhD in electrical engineering. Now we have Dustin Briles, who has a computer sciences degree. They're all math nerds. They're all based on data. And we've tried and tried to have systems that just go in and out of precious metals. The problem with SEM, because of our client base and who we work with, we typically work with what I call the average American who worked hard, blue collar worker, saved their money. They can't afford large risks in their account, and we cannot come up with a low risk, and we define low risk as 20% or less, way to invest in precious metals. The way we look at it is what's considered a top-down approach. And the question all of our models ask is, number one, is this a good time to invest? And that's based on different trends, different indicators, things like that, different time horizons, et cetera. Then if yes, it's a good time to invest, what should we be invested in? And then that looks at the strength of all the different asset classes in there. And again, precious metals has been very difficult because you can lose so much money on precious metals before you have a chance to get back out, that it's never been able to be a big part of our portfolios. And we do have a few things that have exposure to precious metals, but it's less than 10%, so it doesn't really make a big impact overall. And then from there, it just looks at, so long as that asset class is trending higher and the overall market is trending higher, we want to stay invested in there, always looking for different ways to fill in. And from there, we don't do individual security selection. We trust, say, if you are in a precious metals fund, we trust that fund manager to then pick the underlying, whether it's stocks or different parts of precious metals to go into from there, or whether it should just be an index fund that we invest in. So it's always, is it a good time to invest? And if so, what asset classes should we be in? On the income side, we use high yield, we use emerging market bonds, we use inverse treasuries where you can make money on the downside. And then on the other side of things, we, on the stock side, we can go to almost all asset classes, but again, precious metals is just too volatile on that. So it can show up occasionally, but not very often from that. But it's all data driven, not this is what the textbook says we should do.
Jeff, next question on my end. I've had the question asked several times that in some conversations that you and I have had, you expressed that you thought that we were getting close to some opportunities in the bond market, and the natural knee-jerk reaction for most of the public is, well, if we're in a rising interest rate environment, that makes the bond market seem more risky. Can you just put a little context to our previous conversations, please?
Absolutely. Yeah, just to understand a little bit, the reason bonds have an inverse relationship to interest rates. So, and the easiest way to think about it is, if I buy a bond today, it's going to cost me, and we'll just use a treasury bond, $1,000, and the government's going to promise to pay me back $1,000 at some point in the future. If we have higher inflation than we expected, the value of that when adjusted for inflation is going to be lower. So that's why as inflation goes up, you see interest rates go up to try to compensate people for the loss of value of their investment in that bond. And so what we saw this year was interest rates, I think, started at 1.5% on the 10-year, and inflation just kept going higher and higher than people thought. And the Federal Reserve took too long, in my opinion, to fight that inflation. So you ended up at interest rates peaking out so far around 4.5% on the 10-year to try to compensate people for the lost value over that 10-year period of their dollar because of inflation. But as we've seen over the last, I guess, 6 or 7 weeks, we peaked at 4.5%. We're now back down to 3.7%. So treasury bonds have actually had a nice rally. That's one component of a bond return, is your interest rate. the government is considered the most credible, lowest risk borrower out there. And I've always told people, if the US government fails, we're all in trouble because no investment is going to work. There's just not enough hard currency in the world to save the world if the US government fails. So that's why they consider the US to be a very low risk credit risk. As you start to look at other bonds, whether it's a municipal bond, state of North Carolina can borrow money. They could technically default. They're a little bit riskier. So you might see higher interest rates for the state of North Carolina. If you start going out further and look at corporations who are borrowing money, their interest rates have an adjustment above what the treasury bonds are to compensate you for the risk. What we like to use are high yield bonds, which are the riskiest corporate borrowers out there. And typically you have a much bigger premium over your treasury bond interest rate. That's called the spread. Historically, what happens during a recession is you actually see treasury bond interest rates go down because people are buying treasury bonds because they're the lowest risk. And the risk of default goes up on high yield bonds. So their interest rates keep going higher and higher to compensate you for that added risk. And so when that spread gets higher, we get really excited because now you're going to be able to buy distressed bonds at very high interest rates that as the economy starts to recover, the interest rates come down and the value of the bonds goes up. What's a little bit delayed right now, if you go back, you remember pre-COVID, our economic model before COVID was even known what it was warning about a recession. And when we looked at the bond market, we were looking at what's called a maturity wall in 2020. It was going to be in 2020 and 2021, where a huge chunk of high yield bonds were going to mature. And if they mature when we're in a recession, there's going to be large defaults because people won't be willing to lend them money. Well, when COVID hit, the Federal Reserve basically came in and said, we will buy any bond out there to help calm things down. So that allowed a lot of high yield borrowers to basically refinance at lower rates. And according to BlackRock, who is the world's largest bond manager, they all averaged a 3-year refinance. So 3 years from March 2020 is March 2023. So that maturity wall has been shifted. And so what we believe is going to happen is if we're heading into a recession, treasury bonds will be perceived as very valuable. So you'll see their interest rates go down. High yield bonds, as it looks like more of them are going to default and not be able to refinance, those yields are going to go up. So then you get this big spread and a chance to make more money. So the bigger the spread, the more chances we have to make money. So we're literally just biding our time, waiting for the recession to hit, those spreads to skyrocket, and then to jump in and basically be able to buy bonds at high yields and really much lower risk than the market is perceiving. And again, this is my opinion based on the data. That happens sometime in the spring to early summer next year, based on that refinancing wall that we're about to run into.
Jeff, defaults were a big issue in 2008. Can you give us some context of how we look today versus what things looked like in 2008 as with respect to defaults?
Yeah, I don't think if you look at balance sheets, I don't think the balance sheets are as overextended as they were in 2008. And then it was, because every bank was borrowing money from each other and, investing in those same loans, and, they got really tied up in that. So I don't think defaults are going to spike as bad as they did in 2008. It's more likely to be, and we're talking, we had I think 14% default rates on high yield bonds. A normal recession sees 9% default rates. That's more of what we saw in the 2000 to 2002 bear market, where companies just failed. The number BlackRock gave us on the Russell 2000 was, going into COVID, a third of the Russell 2000 companies were considered a zombie corporation, which means they were not generating enough cash flow to cover their interest payments. again, they were able to refinance at much lower interest rates. BlackRock's saying at least 20% of those companies are probably going to become zombies again. So defaults probably will be around the 10% rate rather than 14 to 15% rates like we saw during the financial crisis. And that's just because I believe the Federal Reserve has done a better job regulating banks and not letting them get so silly with their risks like they did in the financial crisis. But that doesn't mean it's not going to still be difficult for a lot of companies.
A lot of this will be my last question. A lot of our clients at Orion use what you referred to as our multi-manager strategies. That's our PPP and mastermind portfolios. Can you just spend a minute or two talking about what your role is relative to looking at those other managers, and how do we determine who's in and who's out, and what kinds of criteria do you use to determine whether somebody's doing a good job or not?
Absolutely. Quite simply, these were managers who have all been around pre-tech bubble. So they've all had experience going through both the tech bubble and the financial crisis. They also have to be quantitatively based and be able to explain to me. So when we decide whether to use a manager or not, we do an interview with those managers to determine if their model logically makes sense and is something that should hold up over time. And then every day I'm watching their portfolios to say, based on the data that I have, are they following what their model says it should be doing? And once a quarter, I do a call with the money manager to just ask them, just have a conversation about the markets, what their models are looking at, and then just using my experience to say, are you second guessing your model? Are you overriding it? Because every manager is going to have periods where they do worse than the other managers in the portfolio, but historically that means they'll have periods where they do better than everybody else in the portfolio, unless they override their model. That's always the number one red flag. And we actually fired 2 managers in 2021 who had overridden their model and started doing things they hadn't done historically. And so my role is basically to one, try to find new managers. There's not a lot out there. SEM, our tactical bond, which is part of the platinum portfolios, PPP, it's quantitatively based, real time going back to 1992, and it's just consistent. It doesn't lose a lot. It just consistently produces what we need to do, and then every recession it tends to have a nice big pop in the recovery. And there's other managers out there who do it differently than tactical bond, and we want to be able to use them so long as they keep following their models. And we are always looking for new managers who come along, because there's some people smaller than us that we just hadn't heard of before that when we start looking at them. So it's just an ongoing monitoring, phone calls, and just making sure that their models are doing what they say they're going to do, with the understanding that they're not always going to be the best, because everybody has periods of time where they underperform the rest of the industry. So far this year, we've had one manager on a watch list, and it's not so much that we don't have documented proof that they haven't followed their models, but they are having their worst year ever. And I actually have a call in mid-December with them, with not only their portfolio manager but their analysts, to kind of figure out what's going on, what they figured out, why they've had their worst year ever, when all of our other managers are still below their worst year ever. And I think, or I should say, their worst loss ever in their portfolios. And I think that's important to understand, is because it's quantitatively based, that's much more reliable than a group of people sitting around in a room and saying, what should we do about the markets right now? Because our human brains will inevitably fail us at some point.
So I think that's, unless anybody else has any other questions, I haven't seen any pop up at the moment. I just want to take time to thank everyone who took time out of their day to join us today, and especially a big thank you to you, Jeff, for taking the time to give us very valuable information. I really appreciate your time, and we'd like to do something like this again in the not too distant future, just to keep everybody up to date.
Yeah, absolutely. Thanks for doing this. We do truly appreciate every single person who's a client of ours. As we go into the end of the year, semwealth.com, again, the market insights is going to be your place to go for any changes to our portfolios. If you're curious about what's happening with the markets, and definitely we'll, as we go into the beginning of the year, and get a better assessment of what the economy looks like. I think it's going to be important to keep these updates going. So in the meanwhile, contact John if you have any questions. If you're concerned about your portfolio, take our risk questionnaire, which is available from our website. And until then, I hope everybody has a very pleasant holiday season, and that we avoid the snowfalls here in our region. That seems to surprise us every December.
Again, thanks, Jeff, and thank you, everyone, and we'll all talk soon.